Welcome to Tech Talk Tuesday. It's Tuesday, November 7th, 2023. My name is Karla, and with me today is your favorite CMT, David Blake. David, how are you doing this morning?
I'm doing well, Karla. Thank you.
Great. Well, let's jump right into it by taking a look at last week's stock market activity and what's ahead.
All right. Well, investors took advantage of an oversold stock market last week and rallied the troops, and the major averages put in their best one-week performance of the year last week. Started out on Monday, rallied right out of the gate. I think a couple of days, the Dow had two 500-point gain days during the week. But anyway, we rallied across the board. Every sector was higher. That was led by REITs. They were up 8.5%. Part of that was as rates pulled back last week. Housing stocks were some of the best performers. That brought down the 30-year mortgage rates on some of these things. They were pushing almost towards 8. I think they're now right down about 7. So the REITs were up about 8.5%, and then we had strong moves in financial, consumer discretionary, and communication services. They were all up more than 7% on the week, which is a heck of a move over a 5-day period stock market. Now, fueling that boost in equities, we had the yields drop. As you saw before, we were pushing 5, and we ended up with the 10-year Treasury down to 4.525. That's almost a half a point percentage move, which is that's almost unheard of. You don't see a move like that in bond yield almost ever. And we also had the 2-year. It landed at 4.87. Remember, it was just up at 5.25 not too long ago. So that's quite an impressive move on the bonds, bringing those rates down to something that you don't see that big of a move. And of course, stocks reacted to it appropriately. We also saw the U.S. dollar come down. As yields come down, usually the dollar will follow that down. It actually hit a 6-week low. Economic data showed we had a little bit slower job growth, which is what the market's been looking for. Friday's Labor Department non-farm payrolls showed we only added about 150,000 jobs. That was versus 180,000 expected. And there's also down sharply from September's report that showed 336,000 jobs, although that was cut down by 25,000 jobs, something that is revised later on. So that was good. We also had earnings that were mostly ahead of estimates. We had some big moves from Roku and Advanced Micro Devices, SBUX, Palantir Technologies, other ones. They tried higher on the results. I'm not going to go over the ones that missed, but if you're missing in this environment, they're going out and you're behind the woodshed and basically chopping it up, because we're seeing some of these stocks that missed going down 25-30% in one session. It's so you don't want to be coming up short in this environment. But anyway, at the end of the week, we had the Dow and S&P 500 were up for 5 days in a row. The NASDAQ was on a 6-day win streak. And for the period, the Dow Jones gained 5.1%. That was about 1,600 points. NASDAQ was one of the big winners. It was up 6.6%. And that pullback in yields really gave a boost to the small cap Russell 2000. It led the way last week. It was up 7.6%. That was by far its best week. And as we see rates pull back, you're going to see possibly some outperformance in the small caps and transports as they begin to go. Now, yesterday we came out, we saw the yields ticked higher, which after a big move like that wasn't real unexpected. And with that little tick higher yesterday, we saw the Russell give back 1.3% of their moves. So we'll watch to see how the yields react over the week. This morning also we had Minneapolis Fed Chair Neil Kashkari come out and say that he wasn't sure that rate hikes were finished yet. So we'll kind of watch on that. Again, that pushed yields up a little bit early, and then they kind of have backed off a little bit this afternoon. So as we're going on here, we're up again. This is actually the NASDAQ, if it closes higher today, would be their 8th straight winning session, which is very impressive. I'm not sure the last time it was on an 8-day win streak, but again, we're so far so good as we start the week, and we'll see how it goes from here.
Okay, so we had a great week, but how is the technical condition and breadth of the market doing?
We strengthened on the technical condition last week. As we finished higher, we were able to regain some of the key moving averages that were kind of resistance levels before. Technical indicators reversed 2 or 3 weeks of losing ground, and they actually moved up into a bullish reading. We had the MACD, which is a short-term trend gauge, it crossed into bullish ground. And the momentum, measured basically by the 14-day RSI, it jumped into a positive read, and it was actually showing it was gaining strength. Big three of the major averages, we did cross back above the 50 and 200-day moving average. They're still trading below their 100-day moving average, which could cause a little bit of resistance going forward, but it's not as big as in play as the 50 and 200-day. But we'll keep an eye on that and see how it goes. And we also, that surge last week, took the major averages up to their descending trend line off of the July and October highs. We'll see how that goes. I think yesterday we're in the process right now of crossing above those downward trend lines. Generally, you don't want to buy the initial break out of that. And sometimes you give it 2 or 3 days, is what the old Wall Street crew used to say. Let's give it 2 or 3 days just to make sure that these breakouts stick, which would, over the next day or two, we'll see if we can hold this up. There's a little bit of a breakout that we had. Now we're also close to breaking what we've been talking about for the last, say, month or two, where we're in a bearish pattern of lower highs and lower lows. If we can break that's also a plus for the market going forward, and would probably signal that perhaps we're going to have a end of year rally. I'm still not convinced of that yet, but we can talk about that a little bit later. We also had the secondary indexes, which I talk about occasionally. That's the transports and the small caps and the semiconductor indexes. They outperformed the major averages. They were all up more than 7%. And market technicians would like to see those secondary indexes lead the market higher and lower. You kind of, when they're showing positive divergence or negative divergence, that's something to really zero in on, because that usually will give you let you know ahead of time a little bit about what the big board is going to do. As far as the sectors go, we're kind of a mixed picture on that. We had the communication services and technology and financial sectors. They're all back above their 50, 100, and 200-day moving averages. That's strong. That means the momentum is there, and those are all good growth and industry or sectors that you want to be in when the market's starting to go. And then you had consumer discretionary, was trading above its 200-day moving average also, which is a plus. That's another growth sector that if we're going to rally from here, you want to be including that, and it's giving you signs that they're leading the bull at this stage. Now, also from that, we had some upgrades from MarketEdge to communication services, technology, and utility. So again, the growth sectors are the ones that are leading the bulls in here right now, and we're also getting upgraded technically on those. Underlying breadth, as you mentioned, we did see a strong reversal from recent trends in the advanced decline lines. Both the NYSE and NASDAQ surged higher. I think we picked up 7,500 units on the NYSE and about 7,000 units on the NASDAQ AD line. So they really had a strong reversal last week. That meant you had accumulation across the board, which is what you want to see, especially coming off of a low. And then finally, we had with investor sentiment, we actually saw we had reached some overdone, overly bearish readings here the last couple of weeks, where we had the hedge funds that were down to 25 or 26% exposure. That was the lowest exposure they had since previous October, which was a bottom for the market. And then we saw the retail investors, which would include the American Association of Individual Investors. They were up to 50% bearish, which is the highest that we had seen since December of last year. So once you get to, when you get these sentiment indicators, what you want to see in that is when you get to these extreme levels, that's generally where they're the most valuable. When they're kind of just floating around in the Midland area, it's good to notice that. But when you start to get to the extreme levels with those, that's when you want to pick up on those, and then they become contrarian indicators that will let you know that, okay, everybody's too bullish or too bearish. This is I will probably want to go against the trend here and make a move on that. So technical condition looks pretty good at this stage. I was very impressed that we didn't give back any of the gains from the previous week on Monday. And so far today, Tuesday, as we go on, the markets are not, they have some modest gains right now, nothing big, but they are up a little bit, which means that, the traders and investors are pretty happy with the gains we had last week, and they're not ready to sell yet at this point.
Okay, well, that seems like pretty good news, at least. For the week coming up, what would you suggest that our subscribers take a look at?
Well, I think at this stage, what you should start doing, on your early in the week, is one of the things that I look at is I'll go to the industry group tab at the top of the page. And in this case, we were down to just 2 or 3 weeks ago. Let's see. Yeah, 3 weeks ago, we only had 11 industry groups that were positive or strong or improving. And now last week, we're up to 31. And then as of today, we're up to 45. So we've had 9 upgrades in the industry group analysis. And I wanted to point something out. You had 2 downgrades, but what's important here is where you want to look. Go ahead and click on that upgrades. Okay, page down a little bit. And the first thing that I noticed when I look at this is number one, you have Banks Central, you have Internet Financial, and you have Savings and Loans. Okay. Now that, I think we also, the previous week, we had upgraded Banks Eastern. Now the banks have been a horrible investment for the last couple of years. But when you see in industry groups like this, where all of a sudden you'll get like 3 or 4 of the different oil secondary, oil primary, like that, that's something that you want to notice, because this is telling you that after they're down at their lows. Click on Bank Central. Let's just look at that for a minute. Okay, so you can see how the underperformance of the banks versus the S&P 500. Now, if you go ahead and click down to the bottom of the page a little bit, you can see that little move on the chart there where it's really turned around there. But now you can see over here we have 1, 2, 3, 4, 5, 6. We have 6 or 7 stocks that were upgraded to a neutral. Some of those will be early entry buys. That's when you want to get into these things. This is starting to tell you. Click on that 50-day relative strength thing there, and you're going to see the key Bancorp, first FITB, first third Bancorp. They're right now. They're outperforming the S&P 500 over the last 5 days. Click on the you don't have it. I always have in my charts. I always try to keep the 50-day relative strength and power rating in there. But if you have a chance, you can go back and do that. But anyway, key Bancorp, first, third, even WFC, which is rated a void, is out, and USB are outperforming the S&P 500 only by 1%. Wells Fargo. So those are ones that you want to look at in here. You also have TFSL and CMA. They've been upgraded to a neutral. They're still underperforming the S&P 500 by a little bit. But when you look at these, you might look at those to see which ones are early entry buys, and then that'll give you a price where if they hit this price, you want to be in on this and move in them. Now you will notice over here to the right a little bit with the slow %K, that's showing you that they are a little bit overbought. So you don't need to jump in there right now and okay, I got to buy these things now. This looks good for the week. If we have a little bit of a pullback after that big move last week, and a lot of these things were up, they're up 10-12% over the last week, and here's the 5-day % change. You have some of them are up 10 or 11%. That allows them to pull back. You don't have to move on them right now. But when you go back a page to the regular industry group analysis page, and we look at those upgrades. Go ahead and click on the upgrades again. When you have 3 or 4 different groups like that, all kind of in the same sector, that's telling you that this is something that you want to be looking at these as far as, because you shouldn't have been buying banks for the last couple of years, but now with these with the rates high and the yield spread starting to narrow again, that's almost flat right now. That's a time when the banks can start to make some money. Also on there, you have retailers, drug based. You had some pretty bad stuff in. You have retailers, drug based, CVS and Walgreens beat up pretty bad. And you can see over the last year, some of those are down 32%. What's the one that's down 29%? So you can see CVS, it was beat up pretty bad over the last year. It was down like 29, 30 some %. That might be one you might want to start to look at. And if you go over some of these things, like I'm looking at right now that some of these industry groups have just been crushed. As we so we go into a period where we are going to be having a little bit of a slowdown. You're not going to be in the high. You don't want to necessarily be in the high flyers. You want to kind of be in the slow, steady industry groups that are going to. They performed okay, and now it looks like they can perform again. Like this footwear, it's up 30. It's up 40% year to date. I'm not sure I want to run out there and start looking at what shoe stocks to be buying here. I'm sure that's Nike and Crocs were probably two of the big ones in there. But some of these industry groups that are just getting upgraded, even like the beverages. If we click on beverages, I noticed that Coca-Cola was just upgraded. Coca-Cola's been down. It's for the year, it hasn't had a great year. That might be one that you want to take a look at. It's probably coming up as far as you look at that chart on top there. It's coming in. It's not far from it's just coming off of a bottom again. And these are the kind of places where, I think Bud was one, and it's also one that's starting to move up again. Budweiser's had a pretty tough couple of weeks, but people seem to still be drinking beer. These are some stocks in here you can look at, find the ones that have been beat up, and it'll give you an opportunity to, as we go into a more steady, slow recovery at 2024, and especially some of these beverages things. If you know about what happens when you go into a recession, beverages are one of the stocks that you want to own, because people, if things slow down, get bad, they're still going to have their drinks and they're going to be smoking their cigarettes and kind of get a little bit jittery. And those are the kind of stocks that you want to own going into a real slowdown like that. So anyway, this will give you an idea. If you go on to Monday to Tuesdays, look at these things, and we'll talk about these going forward and maybe pick out some different stocks. But I did want you to notice that we're seeing the technicals improve on the banking industry enough where we're getting upgrades. And again, that some of these banking stocks are down 25, 30, 40% on the year. That gives you an opportunity where you're not buying stocks that are you're up 50%. You're thinking, how much further can they go? This will give you a chance where we really get a chance to buy something that's oversold and make some money going forward.
Okay, so that's a lot of great information based on your experience, David. Really appreciate some of those pointers. But so as far as the market posture goes, is that still remaining bullish?
Yeah, the CTI is a 2. Market posture is still bullish. And we're profitable on this call. So we said that it probably have some limited upside on this move. I didn't put a target in last weekend. I was going to put 34,000 in, but we were getting close to that in 1 week. So I thought let's see what the market does this week. We may actually I do have some targets on that. I may put them in there, if not Wednesday or Thursday on the daily commentary. I may put it on Friday's market letter, but I do think that I'm still not convinced yet that we will see a strong end of year rally. Are rates going to stay pull back here and stayed back? I don't know. We still have some inflation data to deal with, and the CTI actually it's a projection. It's a forward looking indicator. It'll probably be turning here towards the end of November. We'll have to see how that goes. They can always be extended out, but at this stage, I think that we may be a little bit more range bound than what people are expecting. You still have one group that still thinks the market's going into a recession, or the economy's going into recession, and we're going to pull back. And we have another group that's just all in on the end of year rally. I'm kind of in the middle. I think that we could probably see a little bit more upside, but I'm looking more. I think we're going to be range bound as we keep an eye on these rates to see as they fluctuate a little bit. And it's certainly not some people are calling for rate cuts. I don't think you're going to see that anytime next 3 months or so. So at this stage, we're bullish. I think you can ride what you have. I wouldn't be a real aggressive buyer on anything. I would be looking at some of the banks in here. If we go into a recession, then you probably will want to take some of your profits on banks later on. But if we just move forward and we just have a soft landing, the banks may be a good hold here over the next even a little bit longer term. So go ahead and see something that looks good, is getting upgraded. I think you can probably move for a little bit on here, but I'm looking at the market from here as probably to stay range bound for the next week or two.
Okay, great. Well, that's a lot of very insightful information, David. Is there anything else that you'd like to add to finish off this week?
No, it's pretty good. It's a pretty light, as far as the economic calendar goes. It's pretty light this week. We'll start getting more information next week on like the CPI and PPI final demand. That'll be some of the inflation numbers that we need to look at to see whether or not, if inflation is still coming down. That'll also give us a hint as to whether the rates can continue down. If we're still showing 3.5%, 4% inflation, that may start picking up where the Fed members begin to talk about that. They need to leave rates up here longer. Again, that will keep a top on the market. So right now, I'm kind of neutral on the market. I think that we can probably drift sideways to maybe up for a little bit longer in here.
All right. Well, that wraps up this week's MarketEdge Tech Talk Tuesday. David, thank you again, as always, for all of the great information, and you can definitely catch us again next week.
Okay, Karla, have a good week.